An economy does not simply wake up one morning and suddenly stop functioning. The trigger may be higher rates, oil prices, financial panic, or a collapse in spending. A recession begins when the shock rapidly spreads across markets, businesses, and households. A recession is a significant decline in economic activity that spreads across the wider economy. For the United States, the NBER examines employment, income, spending, sales, industrial production, and GDP. 2 negative GDP quarters are shorthand, but they do not officially define a U.S. recession. Think of the economy as a loop. Spending becomes revenue, supporting wages, investment, and jobs. Those wages create household income, and part of that income returns to businesses through new consumer spending. When one part weakens, the damage can spread far beyond the original economic shock itself. The first root is falling demand, as uncertain households reduce purchases and delay major expenses. Businesses delay equipment, construction, expansion, and hiring because they expect weaker sales in the future. Inventories rise, production falls, and millions of cautious decisions combine into a broad slowdown across the economy. Then comes the feedback loop. Lower sales mean fewer hours, slower hiring, or job losses. Lost income makes households spend less, causing another decline in business revenue and overall confidence. Fear may not start the recession, but this loop can make the contraction significantly deeper. A second route is deliberate policy tightening, usually introduced when inflation is too high and demand must be cooled. Central banks raise interest rates, making mortgages, car loans, credit cards, and business financing more expensive across the economy. The goal is controlled cooling, but excessive tightening can contribute to recession, as it did in 1981 and 1982. A third route is a supply shock, when oil or essential inputs suddenly become scarce. Production gets costlier and purchasing power falls, so growth weakens even as prices rise sharply. The 1973 oil shock illustrates this problem, although several other forces also shaped that particular economic downturn. Financial crises create another route. Often after asset prices rise too quickly, credit expands, and borrowers accumulate excessive debt. When losses appear, lenders restrict credit while households and companies cut spending to repair their balance sheets. In 2007 and 2008, the housing collapse weakened construction, household wealth, bank lending, and business financing across the economy. Some recessions begin outside finance, through a pandemic or a collapse in production and trade. COVID-19 provided a sharp example, freezing economic activity across much of the economy in 2020. The NBER determined the COVID recession lasted 2 months, showing extreme depth can outweigh duration. Why does one shock fade while another becomes a recession? Existing vulnerability often makes the critical difference. High debt, fragile lenders, and weak household or business finances can amplify the original damage. A recession rarely comes from one broken part. It is a shock the system cannot fully contain. No single economic indicator can confirm a recession accurately in real time alone. GDP may fall while employment stays firm, or jobs may weaken before income. Economists examine depth, breadth, and duration across employment, income, production, spending, and sales. One report signals trouble. A broad decline means something more serious. Recovery begins when the downward loop reverses, the original shock fades, and conditions stabilize gradually. Credit improves, production stabilizes, hiring resumes, household income rises, and consumer spending begins recovering again. But downturns linked to financial crises are often deeper and followed by weaker, slower recoveries. A recession is not one number. It begins when shocks spread faster than the economy can absorb.